Welcome back to Everything Money. We're so glad you joined us as always. We've been in this room, Paul, for almost going on 3 years in October here. It's an incredible ride, and we're happy you've joined us again today. Our patrons, you know I love you. Like my wife, I love you. We're here. We're going to talk about FedEx versus UPS. Both of these shipping companies are worldwide, right, Paul? I mean,
yeah, absolutely.
You know, FedEx. This was Castaway, right? He worked for FedEx.
That's right.
It's very sad. Too soon, Mo. And both of us, Paul, my company, your companies, we rely on FedEx. It's funny, Paul. We talked yesterday about the USPS and how whenever you get government involved, it's a little choppy. And I started realizing USPS got beaten up last year because with the election stuff and all this, yada, yada.
Oh, by the way, what do you mean with election stuff?
Well, remember they had regulations for voting, so that kind of hurt them a bit. But we just talked about this, but I digress, guys.
Well, what was the point of that?
I just thought, I forgot that the elections really hurt. I'm holding two pens today. I forgot the elections really hurt the United States Postal Service with trying to regulate the ballots and everything, and so that they got beat down. I remember last fall trying to send stuff. We talked about this. I was trying to send things. It'd be 2 months for a certain letter to just go a few states away. It was bad. But both of these companies, FedEx versus UPS, are very important to my business. I ship hazmat goods, Paul. You ship goods all over the world. And I'd like to look at the stocks today. Mo, of course. And if you look at the 5-year charts for both of these companies, they're near
all-time highs.
Yeah, so we like to look at what's behind the stock ticker price. We'd like to use our 8-pillar analysis, look at the fundamentals of a company, really dive deep into the math, and get Paul and Mo's take from a value investing standpoint and a trading standpoint. So we'll start with my dear friend Paul. Is it Gabriel?
It's Gabriel to you.
Go ahead.
It's actually Gabriel, kids. Okay, so we are looking at FedEx, and there's a nice story about FedEx. Have you heard the story about how it was started?
No.
I love that story.
Well, it's a little misconstrued. I read an interview once with Fred Smith in which he corrected it.
Oh.
Supposedly, it was an idea he had in college at Yale, and he got a C on it. The story is he got a C on it. He corrected it later to say, I don't remember what I got on it. What I said was, I probably got a C, because that's the grades I was getting back then.
Okay.
He was kind of like saying, listen, I'm not remember, but it was one of the most expensive startups at the time. It was in the 70s, and it was, tens of millions of dollars to start this thing. So there's also the story about how it was very close to failing, and he went to Vegas, and he ended up winning a lot of money that saved the business. There was another story involved in it, but yeah. But now he owns part of the Washington football team. Does he own part of the Grizzlies? The Memphis Grizzlies?
I don't even know. Oh, I have no idea.
You don't even know what the Grizzlies are?
I didn't know that was a
By
team.
the way, I'm in love with the Washington football team. I'd be fine with the Cleveland baseball team, by the way.
Why are you in love with the Washington football team?
Cleveland Baseball Club.
I just think it's cool sounding. Anyway, keep going with FedEx.
Okay, so.
Market cap.
FedEx, market cap. Yeah, this is $78 billion, okay? PE of 26, that's an X, and a very low profit margin of 3.8%.
That's really low.
Yeah, very double X. Even their gross margin is only 20%. Okay, dividends paid last year of $6.89. So remember, for all you newbies out there who are new to the channel, dividends are not always 100% guaranteed. You have to look at the free cash flow, which we'll go through later. The free cash flow will determine if the dividend is safe or not. $689 million, okay? Very low return on assets, very low return on invested capital. So far, I'm underwhelmed.
Yeah, that profit margin is so low, Paul. And
I'm actually surprised because if you go to FedEx, or if you go to a FedEx office and ship something, you have no account, it's like $20. Well, hypothetically, if you have a business account, it drops to like $7.
Yeah,
it really plummets. So they have to make really big money on the one-off shipments. You know what I mean?
I'm still amazed that it costs $20 to take a huge, heavy package from here to California.
I meant like a letter.
Oh, yeah.
A heavy package to California is not $20, my friend.
Well, I have an account and all this with UPS. It's about that, I think.
Well, it's a business account, right?
Yeah.
Oh, that's what I'm talking about.
Well,
business,
going,
you get like 60-70% off immediately.
That's amazing. Keep going.
Yeah. Okay.
Pillar number 3, revenue growth.
Yeah. 57.6 to 78.75. Now, my question is, remember, guys, everybody's watching. I don't do any due diligence. I'm looking purely at the numbers to start. That's it. So my first question is, I doubt. Has FedEx, do they have any acquisitions that can be made that really adds big revenue to the business?
That's a good question. I can't imagine.
Unless it's some major acquisition like we're going to buy UPS or DHL or whatever.
What they would acquire. Maybe
what?
Cardboard box companies or something? I don't know.
Yeah, but even then, it's like, I think this is going to be all basically organic. And we'll look at their acquisition numbers on the cash flow statement. But this so far seems pretty good. Net income growth, 1.9 billion to 3 billion. Check mark there. All right. So far, so good, Uncle Seth.
It looks like FedEx acquired a company called Tatex, which is a French business-to-business transportation company, only $55 million.
Oh, that's not adding any revenue to the bottom. That's not adding much.
That's what popped up. So
that's probably the kind of acquisitions that they would be doing.
That's exactly it. So I look at this going, okay, their revenue is probably pretty organic revenue because apart from buying one of the other big players in the market, it's pretty much going to be based on what they're growing.
Yeah, let's do shares outstanding, Paul. We want this number going down over the past 5 years.
It has plummeted from 266 million to 265 million.
Very good.
It is still down, it's still a check, but it's up in the last couple of years. But the bottom line is over the last 5 years, which is our metric, shares are down.
How about the current assets they have versus current
liabilities? Should we talk about the software
this
first?
beautiful software behind Paul you can get as part of our Patreon page. If you join the Patreon, if you've never been a patron, you can join now. You get access to our Discord channel, access to my portfolio, Paul's trades, Mo's trades in the Bid Ask Nation, exclusive videos just for you where we go in depth on some of these companies, and that Discord community from people all over the world can guide you toward your investing purchases so you can learn for a lifetime, which is I'm doing right now. And when it's all said and done, you do get this beautiful software behind
the
Paul.
software guys alone, 80 cents a day is incredible. I mean, this is, you go get this from someplace else, it's $100, $200 a month. Plus you get stock analyzer tool, real estate. As we grow the software, you keep getting it and your price is locked in. Done, 80 cents a day. If you don't do it, I don't have to tell you, you don't take your money seriously. Next.
Let's go to current assets over current liabilities for FedEx, baby.
All right, current assets, 21.7 billion. Current liabilities, 13.6. So pretty good. There's a lot of debt here, a lot of long-term debt. I'm not going to look into that too deeply right now. But
so do they own the plane? I mean, they got to get the planes. And
that's probably a big chunk of their debt is probably the leases of the planes and things like that.
Okay, how about free cash flow growth, which is?
I mean, look, 13 billion in long-term cap lease obligations.
Free cash flow, pillar number 7.
All right, free cash flow. Now, guys, part of the software is I added a line here to make it very easy for our patrons to be able to tell the free cash flow. Because free cash flow is cash from operations, less your capital expenditures. To make it easy, I just put it on here. Negative 489 to a positive 385. Now, look at this, Seth. Three of their last 5 years, they had negative free cash flow, which was very different than the previous 5 years. So my first question is, what happened here that caused free cash flow to change so much in the previous? Look at their average. It's only $400 million a year. So this is a company that's selling for $78 billion, and their average free cash flow is $400 million over the last 5 years. That is a ratio of 200 to 1.
Too much, too high.
X, even though this is a check, it's way too high.
Way too high.
We want it to be under 20 to even start taking a look at it. Why 20? It's just a starting point. It's a number I pick because if cash flow is growing and you have 20 over a 5-year period, but cash flow is growing, awesome. Over the last year, though, look at this, Seth. Their last year is 3.85. So 78 billion divided by 3.85 is about 20. So they're selling for about 20 times a little over 20 times last year's free cash flow. So the question that begs is, do you think this free cash flow is going to continue on? Okay. If this free cash flow is going to build on this 3.85, great. The question I ask for you as the assumption you're going to make here is, why is it so inconsistent over the last 5 years then? It seems like a hard justification to make, saying, oh, this is, unless there could be some very valid reason that cash flow was bad the previous 4 years and suddenly skyrocketed last year, and it was great. The reason I think free cash flow was so great last year was what, Seth?
Well, COVID, yeah. This stock hit a little over $100 in May of last year, and now it's $300.
Yeah, but business-wise, why would cash flow for a shipping company be so great during COVID?
There's no contact.
We couldn't go out.
Send it.
Yeah, ship it to me.
Oh, I see.
You couldn't go to a store and buy stuff. Ship it to me.
When you say ship, I'm thinking containers over ships. Like
FedEx doesn't ship containers.
Okay, sorry.
Maybe they do, but they're focused on how do we get package from here to here.
Business to business. Yeah.
Yes. So last year, when you couldn't go to the store and buy a shirt, what'd you do? You bought it online.
Of course.
So these are why. So I look at this year, last year, going, that's pretty much the only reason they had positive free cash flow. Actually, that's the only reason they had positive free cash flow last 5 years because of last year. So that's something you have to really understand and discount a little bit, because if you give them credit for last year as their ongoing, that seems aggressive based on their history.
Yeah, that's not very practical.
Yeah, it's not a very investor-minded way to look at the company. And once Mo's done doing his charts, we'll pull up the stock analyzer tool and we will do what we think FedEx is worth based on multiples.
I'm going to get grilled in the Patreon. They love busting my chops when I look dumbfounded by your questions. So I'm certain they're going to create a new meme for me, which, I love you guys. So, Mo, what's going on with the trades over there? Are people trading this?
So looking back to October of 2020, you can kind of see if you just draw a line straight across here, it's really just at this consolidation resistance level, with the exception of this big dip in here in the middle or in the beginning of this year. But so this leads me to believe that in order for you to go long on this stock, obviously you're going to need a positive trend, but you are going to have to really break out over and make new all-time highs with really good engulfing candlesticks. This is going to have a very difficult time getting going. For this chart to happen based on COVID, that's what it took to get to these levels. I find it hard to believe that unless there's some really big event, they come out with some kind of new innovative way to ship, I don't know. It's going to be difficult for you to get volume in a stock like this, especially with the competition of UPS.
All right, Paul's going to show the patrons get access to our stock analyzer tool. Basically, it's a stock value predictor or assister, right, Paul? I mean, this helps us get to an actual what should I pay for this company in terms of stock price. And Paul, you're putting in some numbers over there. We do have to get to UPS as well, so let's get after it.
So FedEx, 7-year analysis. I want a desired return of 10%, which is pretty much, this is to determine what it's worth because the market will do that 10%. FedEx, big company, 15 PE and 15 times free cash flow. So it's going to give us two numbers here based on multiple of earnings as well as free cash flow. Okay, so here are the 1, 5, and 10-year numbers. 7.16% a year, 8.15, 13%. So I'm putting 6% for my lowest assumption, 7 for my mid, 8 for my high. This is an aberration. I don't think we should focus on 13%. It was a one-time thing, in my opinion. Share change. I actually issued shares in the last year. However, they've done decreases in the past. So I'm going to say they're going to keep their shares the same as my low estimation, buy back 1%, buy back 2% for my high assumption. Profit margin, basically between 3 and 4%. So 3, 3.5, 4. Free cash flow as a percentage of revenue. I mean, this is abysmal. This is absolutely abysmal. I don't even know what to put here. I'm just going to put 0, 1, and 2. Hit the analyze button. Wow. I actually have a 0 on the discounted well, obviously it makes sense. 0 discounted cash flow. But I have a price range of between low end of 58, high side of 265. What are they currently selling for?
About $300.
Okay.
$300.
So it's still high. Based on, I don't think these are the greatest assumptions in the world. I'd be more focused on these two assumptions. It looks like it's a $150 to $200 stock and based on these assumptions. Now, folks, these assumptions can be changed and you can make the stock, look, ready? Ready for this one? We'll call it 60% revenue growth, 70% revenue growth, 80% revenue growth.
Yeah.
The stock is a $2,200 stock. All your assumptions are gonna be factored in here. I just don't think it's much more than, this seems like it's about right based on earning a multiple of earnings. Free cash flow just seems to be very difficult for the company, and I wonder why that is. I want to understand for this company, why is free cash flow so difficult? It's such a low percentage of their actual revenue. I don't understand why that is.
You want to pull up UPS?
Yeah, let's pull up UPS.
Mo, are they trading UPS? Let's start with the chart over here.
Let's look it up real quick. I'm assuming that it's going to probably look very similar.
Yeah, here it goes. Look
and
at
it
this.
does. So this is a really short term. It's in a downtrend, just like FedEx was. And here's those all-time highs. So same situation. For you to go long on this, you're going to have to break out and make new all-time highs. But right now, it's a short. They do have this gap to fill, so you might have some room to run on the way down. But just know that when you get to this area of $190, which is not far from here, it's 205 right now, you're going to face some resistance. So if you want to maybe do a swing trade, short it down to there, you can get something out of it.
Shorting to me seems a little scarier than just buying.
Yeah, you know what? I personally do not like shorting. I do it, but I really prefer buying. It just gives me a lot more confidence. I don't know. It's a psychological thing.
Mm-hmm. Paul, what's going on over there on the charts? I'm sorry, what's going on with the ticker symbol over here? This is
UPS.
UPS, here we go.
All right, so remember, FedEx had about 80 billion in revenue. UPX has 90 billion. So a little bit higher, not a ton higher, but look at their market cap. 178 versus 80.
That's a lot more. Yeah,
so there's only $10 billion more of revenue for UPS, but the market cap is significantly higher. Their gross margin is about the same. So look at this. PE, 35x. Margin, a little bit better, 5.78%, but their gross margin is actually lower. Not much lower. It's about the 20% range.
Okay.
They have a dividend, 2%, pays about $3.5 billion a year. So we have to make sure, again, that that's stable. And their return on assets, return on invested capital is better than are better than FedEx's. So far we have 2 X's and a pretty good dividend of 2%.
Does that market cap scare you already?
It just, when comparing 2 companies in the industry, it's nice to do that, to say, okay, why does UPS have pretty much the same margins, $10 billion more in revenue, but yet have $100 billion more in market cap? That immediately goes, I don't really understand that. That doesn't make sense to me. Last year we did videos on Walgreens and CVS, and you're comparing them. I mean, this is the nice thing to do. Comparing companies with the industries, not to say one is a buy because the other ones are more expensive, just to say, why would one justify a bigger market cap or a lower market cap than the others? Mm-hmm. Don't make a decision based on a comparison, because that would just sit there and say, to draw an extreme example, if you're dating 3 men, one cheats on you once a week, one cheats on you twice a week, and one cheats on you 8 times a week, would you marry the guy who cheats on you once? No, you're not getting married, period. You're like, listen, this guy just cheats, right? I like bringing up relationship analogies because it makes sense to do that.
Mo, we've been around this guy a long time. Tim, too. His analogies sometimes, where does he come up with some
I don't know.
of these?
I mean, they make sense. They're
because you know why? Everybody understands relationships.
Yeah.
And whenever
you do this. You talk about the last
the marriage thing.
Yeah, the marriage thing.
Because I look at it going like, it's people, whenever I hear people say, like somebody, like one of our YouTube adversaries says that, Tesla will be a 70 PE in 10 years because they're 400 PE now, so 70 is very reasonable. Yeah. It's like, no, it's still stupid.
Yes.
Just like saying somebody cheats on me 3 times a week. Oh, well, this person only cheats on me twice a week, so it's better. It's like, yeah, but it's still a lot, and you still shouldn't do it. Same thing here.
Let's look at pillar numero 3, which is revenue growth.
63 to 89 to 90 billion, check mark there, Uncle Seth.
How about profit growth? Pillar number 4.
3.46 to 5.2, check mark there.
Shares outstanding is pillar number 5. We want this going down like FedEx. Come on, baby.
It is going down, but barely, just like FedEx, 874 to 872, and they also increased in the last year as well.
Current assets over current liabilities for UPS.
Current assets of 21 billion, current liabilities of 16 billion. So check mark there.
Still good. Free cash flow growth over the past 5 years.
Let's see if their cash flow is better. All right. 566 million to 7.13 billion, check mark there. Jeez. Yeah, so an average of 3 billion. Now I will say this. If you look at their last 10 years, Seth, their 2 worst years were years 5 and 4 here, back here, right? So I actually do agree with his average, and I actually think the average might be a little low, but 3 billion times 20 is $60 billion market cap. It's currently 180 billion.
Yikes.
Mm-hmm. Okay, so it's an X there, right? In terms of the ratio. Now, after Mo's done doing the charts, we'll put in the stock analyzer tool again, but I do think that it looks like understand why UPS has better cash flow consistency than FedEx. That's a very important thing, because look at these last 10 years, 6 billion, 4.5, 5.8, 3.8, 4.9. These 2 stupid years, basically no cash flow over 2 years, then 4.6, 3.11, 7.13.
Mo, I'm thinking, how did we not, do you ever get this sense that, how did we not see this coming with Zoom, with Square, with UPS, FedEx? Like, this show was on during COVID when everything fell. How did we not, see this coming?
It's always easy to play Monday morning quarterback. And I look at some stocks like FedEx that was down to 100, and I look at it and I'm like, why didn't I take a bigger interest in it? But during that time, and if you're going to say that you saw this coming, you're totally wrong. I really thought that the market was going to go lower than it was, because we have to remember what the reason was. They were saying that in February and March that we were going to have X amount of COVID cases and it was going to shut down the world.
Yeah.
At that point, we had so few COVID cases, and we were anticipating getting to that point. So when the market dropped and it was down, I'm going to call it 40%, and we still had very little cases, that was in preparation for the cases that were going to come. Then the cases happened, but the stock market went like this.
Weird, right?
So that's why when it was that low, I was like, oh man, this is going to be really bad. It's going to go a lot lower. So way easier to play Monday morning quarterback.
Paul's going to use the stock analyzer tool that you get as a patron member. Again, we already talked about it. And Paul, show them again what you think this should be. You should be paying for this.
All right, so UPS, I have it in here, 7-year analysis, 10% return, 15 PE, 15 price to free cash flow. These are their 1, 5, and 10-year historical numbers. So I picked low, middle, and high, 5, 7, 9% revenue growth. I have shares staying the same, going down 0.5%, going down 1%. Profit margin, very consistent between 5 and 6%, 5, 5.5, 6. Free cash flow as a percentage of revenue, I put 4, 5, and 6. Hit the analyze button. I have share prices ranging from 68 to 136, with 80 to 100 being about the number that we're falling into here based on these numbers right here.
It's currently 205.
Well, if you saw a PE of 35, it's got to drop at least in half. Makes sense. So, guys, every investment is merely the present value of all future cash flows. All it is an analysis. You put your assumptions in, it spits out a number. If you think it's just a stock going up and down, my question to you is, why would it just go up and down? Tiger Woods doesn't just win majors by sitting on his butt every single day eating potato chips on the couch. He goes out there, he puts the work in, he obsesses over practice. That's why it works. Same thing with companies. Companies do better, their stock goes up. When the revenue gets better, the profit gets better, and the shares don't skyrocket out of control, and the debt doesn't skyrocket out of control. Yeah. That's it.
That's a take. We're staying away from FedEx and UPS at the moment. Still good companies, and we can certainly revisit this once they probably calm down on that stock price. So join the Patreon below. Join Mo in the morning at 9 a.m. The big show's Tuesday afternoons at 1 p.m. Eastern. We go live. Join us. We have 700 people join us every Tuesday, and you can be one of them. And we'd welcome you into the Patreon. Thanks for watching. See you next time, guys.